right, folks, we're back again for your weekly roar. And my name's Dustin. I'm on here with my dear friend, closest friend, best friend in the world, and the guy who's functioning in co-CEO role in this world of crypto with me in the roar, Brandon Billings. So today we're going to be a little bit heady. Sorry, we got to go there. A lot of times we're talky, scripty, whatever. Today we got to go deep in a white paper because we've got something to release, and that is the formal white paper for what the banks become in a Web3 world. So we're going to talk about the institutional role in banking 3.0. Um, the rise of Web3 does not signal the end of banking. As a matter of fact, it's something that is incredible. It signals the end of banks as they've traditionally operated. And I say it's incredible because for those of you who've had any challenges with banks or the banking world or finances or whatever, if you've been through things like I've been through, this is needed, wanted, desired change. In a banking 3.0 world, financial institutions do not vanish, they're going to specialize. As an asset, ownership, settlement, and trust move closer to users and code. Banks are going to evolve from custodians of money into operators of financial infrastructure, compliance, and confidence. So, I mean, just honestly, asset ownership, settlement, trust, it's more in the hands of users and code, and it needs to be. Banks are going to become the custodians of those. Instead of custodians of the money, they're going to be the operators and the compliance officers and the confidence builders. So this paper outlines the new institutional roles banks are uniquely positioned to occupy and why their participation is not optional, but essential. I know I got haters out there, crypto maxis. They're like, what are you talking about? Legacy banking's evil. Listen to me. We need each other in this world. And I'm saying to you, legacy banks out there, we're open for business. So come talk to us at Roar if no one else. We need you here.
Balance sheets to infrastructure. Historically, banks have generated value by holding customer assets, intermediating transactions, managing credit risk. But in Banking 3.0, value increasingly shifts towards operating nodes and settlement infrastructure, providing liquidity to on chain markets, ensuring system reliability and uptime. Banks become financial utilities, monetizing throughput, availability, and trust guarantees rather than opacity or delay.
That would be wonderful, wouldn't it?
Yeah,
That last statement's a little loaded. Number two, custody becomes a service, not a requirement. Self custody is a core promise of Web3, but it's not universally practical. People are scared of it. Banks are uniquely positioned to offer institutional grade key management, multi signature custody, recovery, insurance, and compliance overlays. And in this model, custody is opt in, transparent, and provable. It's going to align user sovereignty with institutional assurance.
absolutely. And as financial rules move on chain, enforcement shifts from discretion to determinism. Banks evolve into smart contract validators, compliance oracles, identity and risk attestation providers. Rather than blocking access, institutions help define who can do what, under which rules, and enforced cryptography, or cryptographically, rather, and auditable and in real time.
Exactly. Number four, liquidity providers in programmable markets. This is super cool. In Web3 native finance, liquidity is fragmented, global, and automated. Banks bring deep capital reserves, risk management expertise, and market stabilization mechanisms. Trust me, we have had to do this for ourselves. And Roar, we've had to deal with deep capital reserves ourselves. We've had to build them. We've had to deal with risk management ourselves. We've had to partner with third party platforms, partners, and solutions, as well as develop our own market stabilization mechanisms. These are challenge. They're challenges, but banks are going to bring that naturally and natively. And it's just going to be super natural for us to stabilize. By supplying liquidity to decentralized and hybrid markets, banks earn yield while reducing volatility and improving capital efficiency.
Legacy settlement systems rely on trust, reconciliation, and delay. In Banking 3.0, settlement is programmable, finality is cryptographic, delays are intentional and not structural. Banks that operate settlement layers or integrate smart contract rails reduce costs while increasing transparency.
Number 5A, familiar systems are what we're going to need to upgrade for Banking 3.0. We're working on it. So we see this. We see the ISO needs. We see the software needs. We see the infrastructure needs. We get it. And we got white paper on that. But just to summate, here's familiar systems upgraded for web or for Banking 3.0. Banking 3.0 does not ask institutions to abandon what works. It asks them to modernize it. And I just think about the fact that I used to walk in banks in just maybe even less than 10 years ago and see Windows 95 on some systems. And I'm going, oh my God, I know that. That's Windows 95. God help us, it's insecure. And I remember, still seeing Windows XP and I'm going, oh my goodness. And they said, oh, but our solution only works there. We never were able to bring in the now. That's a problem. Now, we've seen modernization in a lot of ways, but we need to see modernization now. It's just the same idea because there were risks associated with Windows 95 and XP that were not addressed that are now. Same thing now. Many Web3 mechanisms are direct evolutions of legacy financial infrastructure. It's going to get you faster, better, quicker, and lighter. So, for instance, legacy system is Swift messages. The Banking 3.0 equivalent is smart contract settlement. And why it matters, it moves banks from instruction-based trust to guaranteed execution and finality. Legacy system had central securities and depositories. Banking 3.0 equivalent, on-chain ledgers. Why it matters, replaces reconciliation with shared immutable truth. Let me tell you something. I'm dealing with some bankers out there that are trying to replace their central securities depositories with another one just like it. And I'm going, you don't bring that to blockchain. Because smart contracting, it's just so much easier through on-chain ledgering and whatever to do what we do. Legacy system is custodial vaults. And Banking 3.0 equivalent could be validators and key management. Why it matters, it shifts custody from ownership to verification, security, and recovery services. It's actually protective. Legacy system, internal balance sheets, Banking 3.0 equivalent, tokenized assets. Why it matters, it enables real-time visibility, risk assessment, and capital efficiency, let alone the fact that, well, they can't just print it when they want to or do what they want with it or fake it to make it. I'm just saying, I'll say this, for every $1 you put in the bank, they spend 9 of it. If that math doesn't work for you, guess what? It doesn't work for the world as well. Legacy system, compliance teams, Banking 3.0 equivalent is regulatory code. It's functional. What if you don't have all these humans with subjective and it's just freaking code? What if you don't have in the asset world SEC with their